Welcome to the Rosato Team Buyer Presentation. If you're considering buying a home, this presentation will provide you with the information you need to make the right decision and avoid costly pitfalls. In Part 1, we're going to discuss the first 8 items in our table of contents. These are some of the things we're going to discuss today. They're all important, although you should pay particular attention to the pre-approval, the buyer search, and establishing market value. The first topic we're going to discuss is rental versus ownership. This is an MLS for a particular property. We've blocked the confidential information. This property happens to be listed for rent or buy, and this sheet it shows the buying option for $252,900. This is the MLS for the same property, indicating the rental option of $1,495 per month. For our analysis, we'll need another couple of pieces of information. One of them is the mortgage interest rates, and we'll use the 5-year 4.39 shown on this sheet. The last piece of information we're going to need to know is the legal fees and disbursements. As you see here, there's an example that's a little over $1,200. For this example, let's assume that the house sells for $245,000. As you can see here, it would carry for about $1,555 per month versus $1,495 for renting it. There's additional upfront costs of a little over $16,000. Therefore, what we're saying is that for approximately a $16,000 initial investment and an extra $60 a month carrying cost, you'll own a $245,000 home in 25 years, which at that time will probably be worth closer to $1 million. No money down programs are generally available, and you should check with your lender or mortgage broker to see if you qualify. A typical zero down program works this way. It's for a loan size generally between $50,000 and $500,000, and it's for the primary residence only. And the total debt service ratio has to be maximum of 40%. Some of the terms that are available, the most important one is the administration fee of 4%, which is added to your mortgage. You have to keep that in mind. The underwriting criteria is you have to be a minimum 2 years with the same employer. If you're self-employed, the business has to show a positive trend. There can be no derogatory within the last 12 months, no record of previous bankruptcy. As far as debt's concerned, you can have some minor problems that are acceptable, such as late payments, but all debts need to be paid. And the appraisal must indicate a stable to improving market trend. As far as closing costs, you're going to have 1.5% of the purchase price, which can't be gifted or borrowed. Another program is the cashback mortgage. Assume you need $200,000 in financing. You borrow 5% or $10,000 from a parent as a down payment. The bank will give you a $190,000 mortgage for the balance. The bank will also give you a $10,000 as cash back to repay that parent. Note that the bank will charge you approximately 1.5% extra on your 5-year term. The two main reasons to take advantage of these programs is, well, you can enjoy your new home right away, and most importantly, in a hot market, your ability to save for a down payment may be outpaced by increases in the real estate market. Rent to own is a plan that's used by some private companies. Now, generally this requires a good credit rating, non-refundable deposit, and a monthly equity amount added to the rent, say $150 for a term of 7 years. Now, over those 7 years, you would accumulate a total equity of about $17,100. Note that you could do the same thing by renting somewhere else, but the difference is you get to live in the house. Now, this applies to only certain properties offered by particular companies. It does not apply to homes offered for sale privately or on the real estate board. There are many programs that are available. Just check your federal, provincial, and municipal websites to get the details on current programs that are available to you. These are some of the upfront costs you need to keep in mind. On a high-ratio mortgage, you may be required to pay for a mortgage loan insurance premium, a processing fee, and perhaps even an appraisal fee. On an offer, you're going to have to put some kind of a deposit down, typically between $1,000 and $10,000. If you're buying a condominium, a status certificate is required, and that may cost you about $100. And also, if you're going to be doing a home inspection or a septic inspection, there are some costs there as well. If the property is on a well, you may need to test the water. The mortgage lender may also require, in some extreme circumstances, a survey or certificate of location, and sometimes too they may require you to pay the property insurance ahead of time. You'll have to pay land transfer tax unless you're a first-time home buyer, and you may qualify for a refund for up to $1,725. or if you're buying in an RV park where you generally don't have to pay this unless the property has tenants in common. There are also some legal fees and disbursements that you'll have to pay as well. With new homes, you have to consider who's paying for the warranty and the GST. With condominiums, you have to keep in mind that you have to make the initial payment. There are also moving expenses, connection fees, sewer charges, and debentures that you have to consider. If you're thinking about buying a home, pre-qualifying is an important step. This can be done by the lender, the real estate agent, or yourself by going to the CMHC website or our own website. You're not approved to buy a home, but it does give you a general idea, and you can sort of look around to see what's available in your price range. Before you start looking for a home seriously, you need a pre-approval. This is done by the lender, who will do a credit check, verify income and other debts. The lender will then determine if you qualify, how much you qualify for, what programs are available to you, establish the interest rate, etc. You can now shop for a home with some confidence. Once you've had an offer accepted conditional on financing, before you close the deal, make sure you get a loan commitment, and this is issued after the lender has approved both you and the home. Credit checks are done typically either at Equifax Canada or TransUnion Canada. You can do your own credit check by going online to either of their websites for a small fee and instantly get your credit check done. Here's an example of a credit score that came back from TransUnion that was at 799. This was in the good range, and likely you wouldn't have any problems getting pre-approved. If, however, your credit score is lower, say below 600, that doesn't mean that that's the end of it. You can talk to your lender or broker, and they will discuss with you ways and means to improve your credit score. Here's 3 examples of mortgage loan commitments. And although they come in different sizes and shapes depending on the company, they all must have the basic property information, the buyer information, and the general terms of the agreement. Here are some mortgage terminologies. A pre-approved mortgage is a free and no obligation deal that lets you make an offer on a home, and the rates are guaranteed not to go higher but can go lower, which is a very good reason for getting pre-approved. A conventional mortgage is one that doesn't exceed 75% of the purchase price, and a high ratio mortgage is more than 75%, and of course there are premiums associated with it. A first mortgage is of course the first debt registered against the property. A second mortgage is usually the one registered after the first, and usually at a higher rate. An open mortgage allows you to repay the mortgage in full anytime without penalty, but the interest rate is usually higher. A closed mortgage offers security of fixed payments for fixed terms. Interest rates are generally lower, but they do allow for prepayment privileges. A fixed term mortgage has a fixed rate for a fixed term, and an adjustable rate mortgage is available also as well. The monthly mortgage payments remain constant, but the ratio between the principal and the interest fluctuates. You can use the equity of your home in order to get a secured line of credit as well. Equity mortgages are generally offered to applicants that don't meet normal income or credit qualifying guidelines. There are also multiple term mortgages and 6-month convertible mortgages, as well as all-inclusive mortgages that pay for all your legal fees, disbursements, transfers, and so on. And finally, we have bridge financing, which is a short-term loan needed to cover a time gap when closing dates don't match. Sales have to be firm, and rates charged are generally 2 to 3% above prime. In real estate, there are different possible forms of agency relationships. In seller representation, the agent must do what's best for the seller of a property, and the written contract called a listing agreement creates an agency relationship between the seller and the brokerage. In buyer representation, the agent must do what's best for the buyer of the property. A written contract called the buyer representation agreement creates an agency relationship between the buyer and the brokerage. If the buyer doesn't wish to be represented, he can select a buyer customer service. The buyer, however, cannot be a party to another buyer representation agreement with another broker, and this is a non-exclusive relationship. If a buyer who is represented by an agent of a particular brokerage enters into an agreement with a seller of the same brokerage, they're considered to be in dual agency, and there are certain things that they can or can't do as follows. In dual agency, these are the things that you may not disclose to the seller or the buyer without written permission. This is the end of Part 1. Please proceed to Part 2.